Talking with John Ward. When I was at Chase, we had a really memorable day, a scary day in 1987 in October when the stock market corrected itself after a big upturn in those middle 80s when it got up in the 7,000 range. All of a sudden, I was at lunch in the Chase cafeteria, and someone said across the room, "It's down 500," and everybody knew what that meant. And tell us, what was that like? What were some of the experiences that you've had with how the economy and the market has affected the industry?
Well, I was in the board of directors room with Art Ryan that day, one of my first meetings in my new position in being his credit officer. And we were looking at the screen, seeing this happen, and it was frightening as hell. And it shows that certain times there are economic problems that have spin-over effects to the stock market. And I guess the one that's really the classic is the 2007-2008 mortgage crisis. Now, I'll tell you why I think that was a big mistake. As I mentioned before, the PFS people were credit trained. When people were originating mortgages, those days were gone, okay? They were not credit trained. Some would bring it in and have the credit look at it. Other people said, you don't even need to do it because we're not going to hold the asset. The appraiser is another one who is not the most trustworthy person to deal with. He'll give you a valuation, whatever you need. Then you have the rating agency as they're packing this stuff together to sell it off to the marketplace by the investment banker, and he's traveling the globe, selling off nuclear waste. And that's what happened, and that really had a big impact on the economy. But I think it was easily stopped. But remember, the rating agency wanted business, the appraisal wanted business. It wasn't going to be on the bank's balance sheet except for the period of packaging before it was sold off. This really was a total disaster.
From your background in credit training and mortgages, it really must have been amazing to see what happened, that the lack of discipline applying to checking the credit rating of the mortgages. And do you feel like the remedies, Dodd-Frank in particular, the testing banks for their asset quality has been a positive, or has it been an overreach?
I think it was an overreach, but remember, I was running an international bank at that time, so it had no impact on me. However, it had an impact on other people. I truthfully believe today there shouldn't be any merger of large banks. We have enough. I believe there are too many community banks, and they could be merged because a community bank can't be bought by Citibank or Wells Fargo or anyone like that. And I think that by putting all these regulations in, people had to hire more and more people who didn't earn a nickel for the corporation, and I think that was a bad decision, but that's me. But I would never have let the problem develop if I were running a bank, because I believed in credit. And I think credit is critically important, and credit cycles come and go.